So in this video, I'll explain within a few minutes if US nationals have to file a Thai tax return. I'll explain when they have to and when they don't have to file so that people that don't need to file don't need to worry. The people that do need to file have the full information. So as you can tell, I'm not from the US, I'm from the UK, but I have a reasonable knowledge on the US Thai double taxation agreement, and Expat Tax Thailand are experts for Thai tax filing. So we'll talk about US assets that are remitted to Thailand. Do you have to file a Thai tax return if you're an American or not? It all depends on what you bring in, how many days that you stay in Thailand. So let's talk about when you don't have to file a Thai tax return. So if you don't have any overseas income that you bring into Thailand and you don't have a domestic income, so a local rental property or a local salary, then you don't need to file a Thai tax return. So if you don't have foreign source income and you don't bring that into Thailand, let's say you've got cash in the bank from previous years, so before from pre-2024, and you can document that and show this, then you don't need to file a Thai tax return. But if you have a domestic income, so what does that mean? It means a Thai rental property, or you have a local salary, then you need to file a Thai tax return regardless of the amount of days you stay in Thailand in a calendar year. Now, if you stay in Thailand 180 days or more, then you class as a Thai tax resident. Now, that goes on a calendar year, so the 1st of January to the 31st of December. Then we need to see who needs to file a tax return. Just because you're a tax resident doesn't mean you have to file a tax return. You have to have be over the minimum thresholds. So if you remit, transfer foreign source income into Thailand and you are a Thai tax resident, then you need to file a Thai tax return if you're over the minimum thresholds. Let's explain that in simple terms. So if you are an American national, you're living in Thailand 180 days or more, and you bring in, transfer, use an ATM, and withdraw money that is from foreign source income. Let's explain what that means. So a pension income from the US, or you've got an investment portfolio and you're in cash partly, you've got capital gains or you have dividends, and you bring that into Thailand, transfer to Thailand, or transfer via Wise or something like this. Or if you have a US rental property income, or you sell a property in the US, or you have a salary or dividends, and you bring those into Thailand in a Thai tax year, then you have a Thai tax filing obligation if you are over the minimum thresholds. So let's talk about the minimum thresholds. They're really low for pension income. This excludes Social Security. So other pension income, if it's over 220,000 Thai baht per year that you bring in and you're 180 days or more in Thailand, you need to file a Thai tax return. That's for someone who's married and they're filing jointly. If you're single and you're filing as an individual, then you can only bring in 120,000 Thai baht before you have to file a Thai tax return of pension income. So I hope that makes sense. If you've got a US Social Security pension, however, and you bring that into Thailand, remit into Thailand, and that's your only source of income, under the double taxation agreement, good news for yourself, you don't need to file a Thai tax return because it's excluded on the double taxation agreement as an income source to be taxed in Thailand. It's only taxed in the US. Also, if you've got a military pension or a civil service pension, then that's excluded under the DTA as well. But if you've got any other type of private pension or annuity, for example, if you bring it into Thailand, 401k, for example, Roth IRA, then that is assessable income if you bring into Thailand or transfer, remit into Thailand. Let's talk about other income sources. If you sell an investment, you've got an investment portfolio, got a brokerage account, general investment account, and you sell assets, remit some of the assets to Thailand, you need to file that on a Thai tax return if you've made a capital gain or you've brought in a dividend, for example. That needs to be filed on a Thai tax return. The limits, thresholds are really low on that. They are 120,000 if you're filing jointly, 60,000 if you're filing as an individual. So really low minimums on there. Rental property income, if you bring in US rental property income, you need to file a Thai tax return if it's over the minimum thresholds, and which is the same as capital gains. Bring in dividends, salary, you need to file that on a Thai tax return. regardless if you've paid tax on this or not. You can use the double taxation agreement to claim a tax credit for some of the tax you've paid in the US, but it doesn't mean you don't have to file. But if you've got pension income, the double taxation agreement states you have to file, pay the tax in Thailand on that pension income that you bring in. You can use that tax paid as a tax credit to offset the tax in the US for your pension income. All other types of assets, then you file in Thailand and use the tax paid in the US as a tax credit to bring to file in Thailand. But you need to file a Thai tax return if you bring in foreign source income over the minimum limits. So I hope that's been useful. We have 2 1-hour videos regarding US taxes and US remittance, so it might be worthwhile watching those if you'd like more information. Feel free to visit our website, expattaxthailand.com. We offer free consultations and we can help with filing services, which is all online, fully remote, very simple for American nationals because you're used to doing it at home. So thanks for watching.